So good morning, everyone. I'd like to welcome you to our webinar, 2020 Wealth Transfer and Charitable Planning, Navigating the Landscape. My name is Laura Ducceschi, and I'm President and CEO of the Scranton Area Community Foundation. And I'm pleased to be joined this morning with the team at Drucker and Scaccetti. They have a breadth and wealth of experience in various areas relating to tax planning, business planning, charitable planning, all of the aspects around there that could benefit so many people on this call today. And the foundation, as many of us know, have various areas within the community that we focus on. We're a public 501c3 community foundation. We were started with a $1 million bequest by the Scranton Area Community Foundation. And we take very serious our role as a charitable partner and a steward of charitable funds. And education for professional advisors, education for donors, philanthropic individuals, our community. We take that role very seriously, and this webinar topic is very timely. It's full of information that I think would be very relevant to many of us on this call, whether we're on it for general information, for CE accreditation, for CFRE accreditation. So I think between all of the experts from Drucker and Scaccetti on this call and some of the general information that I'll provide from the Scranton Area Foundation that ties into what they're going to talk about, I think you'll find it very interesting and hopefully very useful over the next hour. And I will let everyone know that you can use the chat feature, you can use the Q&A feature, and feel free to ask questions along the way, and they'll be answered as when possible by the panelists on this call. So a little bit about, again, the foundation. So we are one of 700 plus and growing community foundations in the nation. We're accredited by the Council on Foundation, which is the benchmarking entity for foundations, particularly public community foundations that are in essence owned by the public because they're comprised of donor funds that are set to manage various individuals' charitable goals. So from that $1 million bequest in 1954, the foundation has grown to over 45 million in endowed assets to benefit our community, and that's 200 plus individual funds within that, and an additional 30 million of private foundations under management. So we are in essence the community foundation of the Scranton area, but we do serve areas around northeastern Pennsylvania. We're governed by an independent board of governors. Again, our goals, in addition to being a charitable resource where we want to be as innovative as possible in looking for the charitable planning tools that we can partner with professional advisors to help their clients carry out their philanthropic legacy as part of their estate planning and life planning goals, or just work directly one-on-one with donors. That is a key part of our goals, being that charitable resource, serving with the tools, the back end, the front end administrative management to that, facilitating training programs, serving as a catalyst and a convener, kind of that independent backbone of the community to bring people together to care about specific issues, to confront regional challenges. They can be issues in transportation, housing, animal welfare, issues impacting women and girls, racial equity. Serving as that steward that's, again, overseen by our independent board of governors of these 200 donor created funds, and following the majority of this presentation, which is going to be about the tax and estate planning issues surrounding the post-election world, I'll just talk a little bit about the different fund structures and how they can play into that. And then a grant maker, probably what people know about us the most, in that providing those community needs grants, those innovative grants to nonprofit organizations, and helping donors provide grants from their funds to carry out their goals. So one of the things we'll note is that it's very fresh in our post-election environment. We can honestly say the tensions are still a bit high surrounding that, and so I want to reiterate our framing that the foundation is here simply to provide information to the public, and we are a completely non-political, unbiased, and nonpartisan entity. We don't support or endorse any political candidates. We're here to provide this information. And, you know, we're happy to do that, but it is a fresh topic. So regardless of what side individuals sit on the political spectrum, we're here to provide the most timely and pertinent information to where we are right now in the world. And with that, I would like to acknowledge the distinguished team at Drucker and Scaccetti, Jeffrey Mesko, shareholder and partner, Rachel Kaiser, shareholder and partner, Nastasha Markham Coletta, managing associate, Elizabeth Witko, managing associate, and Febi Sugianto, our associate at Drucker and Scaccetti. And so what I'm going to do is I'm going to turn it over to Jeff Mesko, who is, again, partner and shareholder at Drucker and Scaccetti. And, you know, Jeff has Scranton roots. He was born and raised in Scranton. I believe he started at Drucker and Scaccetti as an intern and was the first youngest to join as a management associate, to be, I guess, as a management associate, and now he's a shareholder and partner. He'll perhaps tell you a little bit more about himself, but I will say that he has a breadth of experience in accounting, tax compliance, business consulting, working in the real estate and private equity industries, even focusing on private foundations. I believe he got his start while he pursued his undergraduate education, working in his family's business as a staff accountant in Scranton. He has a Bachelor in Business Administration degree from Temple, graduating magna cum laude, received a Master in Taxation from Villanova Law School, and he's a member of the American and Pennsylvania Institutes of Certified Public Accountants. So with that, I'm just going to turn it right over to Jeff, and he can move into the majority of the presentation that we're all here for. Just give me one moment, and I will do that. All right, I believe, Jeff, you can, or Nastasha can share your screen.
Thank you, Laura. Thank you for having us today. We really appreciate the opportunity to present and discuss, and hopefully have somewhat of a discussion with everyone on the call today. As you alluded to, Drucker and Scaccetti is a tax and consulting firm, and we have almost 100 people, primarily in Philadelphia, but we also have a Scranton office and a Scranton presence with myself and Elizabeth Witko, who's also on the webinar today. And what we really do is we try to align or integrate your personal, your business, or your charitable goals with tax strategies. And I think you'll see that come through here on our presentation today. So with that, I think that's enough about DNS. We can probably go right into it. Thank you again for having us.
Gotta unmute myself. Made that mistake several times during this presentation. Good morning, everybody. I'm Rachel Kaiser, so we'll just get started with the presentation. Nastasha, if you want to go to the next slide, we'll talk about the agenda. There we go. Okay, so some of the topics we promised to talk about today, we're going to be talking about the current landscape in wealth transfer and charitable gift planning. So with that, we're going to start off with the factors that are kind of creating for this perfect storm for estate planning this year in 2020. We'll get started with that. And then as a result of that, some strategies that you should consider doing now related to those factors. We'll move into the CARES Act that was passed earlier this year, and then talk about donor advised funds versus private foundations. I think that lends itself right into the Scranton area foundations wheelhouse. We'll move then into Secure Act IRA planning, well, post-Secure Act IRA planning. Touch on state inheritance tax. We're going to focus mainly on federal estate tax, but there are some state inheritance tax issues that we should discuss. And then finally, we will discuss some inheritance loss prevention, which basically is about, thoughtful wealth transfer to the next generation, and kind of avoiding what many times happens where inheritance is lost when it reaches a second or third generation. Okay. As I said, the first thing that we're going to talk about are the 2020 economic and tax law factors that are currently they're making for this perfect storm for wealth transfer planning. So we'll get into each topic a little bit more in detail, but just to give you the list up front, right now, there's a temporarily increased lifetime federal estate tax exemption. So it's much higher than it has ever been in the past. Like Laura was talking about, we know the presidential election was just last week, so we know who the winner is now. So we'll talk about the current tax law as it is, and then also President-elect Biden's proposals that he's made during his campaign. Obviously nothing is set in stone, but just things that have been kind of thrown around. Currently, interest rates are very low. The applicable federal rate and the 75/20 rates that are used for many estate planning strategies are at a historically low rates. They were, I think, at the lowest probably in August or September. They've been ticking up a little bit, but still extremely low in comparison to even a couple of years ago when they were already very low. And then the last one is depressed values of certain businesses. So we know the market value, the stock market has come back since it's low in March. But certain companies might be able to get low valuations because maybe they're impacted by COVID and they haven't been able to recover yet. So there could be some planning related to that. So just to go further into the temporarily increased federal estate tax exemption. So just to give you an update on the annual exclusion. So the annual exclusion at the $15,000 limit, that's not going to change for 2020. So that is the amount that a person can give to an individual each year without incurring estate being subject to gift tax. So a married couple can actually give an individual $30,000 as long as they're going to split those gifts. So that's not going to change for 2021. For the estate tax exemption, which is kind of the bigger topic here, for 2020, the estate exemption is $11.58 million per person, so $23.16 million per couple. That's set to increase to 11.7 for an individual in 2021, or 23.4 million per married couple. The big thing there is that was only that basically was doubled in starting in 2018 under the Tax Cuts and Jobs Act. It's set to revert back to the $5 million per taxpayer in 2026. However, if say the Senate goes a majority Democrat, or perhaps even with not that happening, there could be a reversion back to that $5 million per taxpayer prior to 2026. And then coupled with that, the IRS in 2019, I believe, they put out a notice that said they would not claw back that extra exemption. So if someone were to use their entire $11.58 million exemption in 2020, and then say the exemption goes back down, it gets reverted to $5 million in 2021, the IRS will not take back that $6 million. So it's kind of a use it or lose it exemption that's available only now. It's at least going to be available until the end of this year. We just don't know, but it potentially could be available until 2025. So anyone that's in a situation where they will have a taxable estate, regardless of whether they're in the $11.58 million exemption scenario or the $5 million scenario, they should think about doing things potentially this year. It really depends on the situation, but it's always good to talk to advisors to get that planning started early.
So just a caveat before I march through this example and then other examples that we're going to have later in the presentation are simplified just for time purposes. And so issues like time value of money, et cetera, were not considered in the calculation. So to show the impact of the use it or lose it exemption, assume that we have a married couple with a $30 million estate. In the first column, we assume the couple does not use their increased exemption. And when they pass away, the exemption has already reverted back to the 5.6 million. Combined, their exemption will only be 11.2 million. So their taxable estate is 18.8. At a 40% rate, the federal estate tax on this would be $7.52 million. As a result, only 22.48 of the 30 million is left to their heirs. So on the chart, you can see this. The yellow is the amount that's going to be going to the IRS, and the purple is the amount that goes to the beneficiaries. In the second column, the same couple instead makes lifetime gifts using the full 11.58 exemption each. At their death, the taxable estate would only be $6.84 million, with a federal estate tax of about $2.7 million, leaving roughly $27.3 million to their heirs after tax. So that's a difference of approximately $4.8 million in comparison to scenario 1. It's important to note with this analysis that it does not include appreciation on assets that were gifted out of the couple's estate during their lives. So in the years after the gift, the value of those assets can grow, and that appreciation is then outside of the couple's estate and therefore not subject to estate tax. We understand that it may not be practical for everyone to use up the entire increased lifetime exemption while it's an option. However, this example is just meant to show that failure to do so really does mean real tax dollars and a significant shift between what can be left to beneficiaries and what's going to be paid to the IRS. It's also not necessary to use the entire amount of the increased exemption to get the benefit. For instance, we have an unmarried client that wanted to transfer his interest in the family business to his children. The business was worth about $10 million after discounts. During this period of higher exemption, he was able to transfer the entire interest out of his estate free of gift or estate taxes. In 2026, he'll not have that option. Plus, the business could have appreciated in the interim. And it's important to note here also that this exemption amount is fluid because it's tied to inflation. In addition, we don't know if Congress will act to permanently keep the higher exemption or even reduce it below $5 million. So every decision does come with risk. But as of right now, if you can gift anything over $5.6 million to your beneficiaries, you will be saving your estate 40% of tax on that gift. Now that the presidential election results have basically been confirmed, we'll highlight a few of President-elect Biden's proposals relating to estate planning. So right now, as we mentioned, the federal estate tax exemption is set to revert automatically in 2026 back down to $5 million adjusted for inflation. Biden has proposed to reduce the lifetime exemption amount back to $5 million before 2026. But one of the most significant changes that he's proposed is the elimination of basis step up on inherited assets. Right now, beneficiaries receive basis stepped up to fair market value when you pass away. But under his proposed changes, the beneficiaries will instead receive carryover basis, which could amount to significant income tax consequences for the beneficiaries. He's also proposed taxing that unrealized appreciation upon death and increasing the top estate tax rates. So Rachel touched on this earlier, but when people think of estate planning, they rarely consider how the fluctuation of interest rates may impact their wealth transfer goals. But in a low interest rate environment, you can generally gift away more with less income, estate, and gift tax ramifications. Interest rates also can impact the tax efficiency of certain estate planning strategies and may affect the best time to establish those strategies. There are two main interest rates that are relevant to estate planning: the applicable federal rate, which is the AFR, and the 75/20 rate. The AFR is the minimum interest rate the IRS permits. These are published every month by the IRS and are currently at extremely low levels. Although, again, as Rachel mentioned, they've been slightly starting to tick up since October. And the 75/20 rate is used to discount the value of certain remainder interest or annuities to the present value. So we're just going to briefly discuss 4 different estate planning strategies that are significantly impacted by interest rates. These are intra-family loans, grantor retained annuity trusts, sales to intentionally defective grantor trusts, and charitable lead annuity trusts. A common estate planning strategy is the intra-family loan. The goal of this loan is to provide capital to family members at a low cost to them, often so they can purchase a home or invest in the market. Regarding the investment example, this can be a powerful wealth building tool because any gains are kept by the lendee, while the seed money for that investment is costing them very little to use. In order for this loan to not be considered a gift, the lender must charge interest at least at the AFR rate. Assuming the loan is for longer than 9 years, that's only 1.17% right now. This loan has a greater tax benefit in a low interest rate environment because the minimum interest required to be paid to the lender is smaller, which allows the lender to receive less taxable interest income without triggering gift tax or imputed interest. And an intra-family loan can be even more powerful wealth transfer tool when you're coupling it with annual gifting. So the lender can gift up to the annual gift exclusion amount without triggering any gift taxes. That means that if 2 parents made a loan to their child and the child's spouse, they could $60,000 of principal could be forgiven each year without any gift tax ramifications. And if an intra-family loan already exists, parties should really consider refinancing it right now while the interest rates are so low. Another common estate planning tool is the Grantor Retained Annuity Trust, or GRAT. The goal of a GRAT is to use an irrevocable trust to gift the expected appreciation of certain assets to your beneficiaries with little or no gift and estate tax ramifications. Because you're trying to gift away the appreciation or income stream on the assets, not the assets themselves, it's a really beneficial tool for those who still will require the assets either currently or in their retirement. So a GRAT is considered defective for income tax purposes, which makes it a grantor trust. This means that during the life of the trust, the grantor will be taxed on the income, which further reduces their estate, while also allowing for more of the trust assets to transfer to the beneficiaries. Although the grantor is paying income tax on amounts that will likely go to the beneficiaries, it's not treated as a gift. A GRAT is effective though for estate tax purposes, meaning that it transfers assets out of your estate. And a common version of the GRAT is the zeroed out GRAT, which is drafted so that the present value of the remainder interest is zero, thereby requiring no lifetime exemption to be used in the creation of the trust. So this can be a really great strategy for any individual who's already used up or is about to use up their lifetime exemption. Just so you can see visually how this all works. To set up a GRAT, the grantor creates a fixed term irrevocable trust and transfers assets to it while keeping the right to receive an annuity. When the term expires, the trust terminates and the beneficiaries receive the remaining assets, which would basically be just the appreciation of those assets. When the GRAT is created, the grantor has to report a gift of the present value of the remainder interest that's expected to pass to the beneficiaries. And just a note here, you cannot use the annual gift tax exclusion amount for this gift because you are gifting a future interest, not a present interest. And because you want the rate of return on the trust assets to exceed the 75-20 rate, which that's what's going to allow any of the excess to be transferred to the beneficiaries free of estate and gift tax, you'll only want to fund the GRAT with assets that are likely to appreciate. And to produce an even greater estate tax benefit, instead of naming beneficiaries individually, you could name a trust as a beneficiary. Real quick, just to march through an example of just how impactful GRATs can be, assume the grantor creates a 3-year GRAT with highly appreciating assets worth $6 million and retains the right to receive an annuity payment of $2 million each year. Based on the IRS tables, assume that the present value of the remainder interest to the beneficiaries is $500,000. So that's the gift that the grantor is going to have to report to the IRS. Now assume that the assets appreciate to $9 million, which means at the end of the 3 years, the grantor will receive their $6 million back, so their balance sheet doesn't change overall, and the beneficiaries will receive the remainder of the trust, which is $3 million, even though only $500,000 of the grantor's lifetime exemption was used. Obviously, this is an oversimplified example, but successful GRATs can provide a very powerful means of transferring wealth to your beneficiaries while using little or none of your lifetime exemption amount. And individuals should really consider GRATs right now for 2 reasons. One, interest rates are low. The annuity is calculated based in part on the 75-20 rate at the time the trust is created, not when it terminates. So even if the 75-20 rate goes up, it does not matter. If the assets appreciate more than the rate, the beneficiaries receive that excess free of gift or estate taxes. The lower the interest rates are, the more likely appreciation will exceed that rate. And 2, many on the Democratic platform have communicated their desire to either eliminate zeroed out GRATs or otherwise somehow limit the benefits currently received from using GRATs. To our knowledge, however, though, Biden has not commented on this topic. So we're not sure what will happen in the future. And while GRATs are a great wealth transfer tool, they do have some setbacks. So for example, if the grantor dies before the term expires, a portion of the assets will be included in their estate. For this reason, we often recommend short terms for a GRAT, like 2 to 3 years. Additionally, the grantor should consider liquidity issues when funding a GRAT. It's imperative that the trust has enough cash flow to be able to pay the annual annuity payments. Otherwise, stock is going to have to be transferred back to the grantor. And for this reason, grants are often not the best option for closely held stock or partnership interests. If your goal is instead to transfer closely held stock, or you want the annuity period to be longer than just 2 to 3 years, an intentionally defective grantor trust, or IDGT, is a more suitable option for you than a GRAP. So with an IDGT, the grantor sells highly appreciating assets to the IDGT in exchange for an installment note. The grantor should make an initial gift, which we call a seed gift, of at least 10% of the total transfer value to the trust to ensure that it has sufficient capital to make its annual payments to the grantor. And to the extent that the growth rate on the assets sold to the IDGT exceed the interest rate on the installment note, the excess is then passed on to the beneficiaries free of federal gift or estate taxes. So here you can see it does look very similar to a GRAP. In the example pictured here, assume a business owner's interest in their business is worth $10 million and they want to sell that to the IDGT. So they sell their interest and receive an installment note for $10 million plus interest over 20 years. At the end of the 20 years, the owner has received back from the IDGT 11.2 million in principal and interest, but the business value has appreciated to 25 million. This means a difference of 13.8 million, which is the 25 million appreciation less the amount the owner received from the installment note, was able to move out of the owner's estate free of gift or estate taxes. And while there's a lot of potential benefits to using an IDGT, there are some disadvantages. For example, if the grantor passes away before the end of the note term, the note is included in their estate. However, since the note is at the original purchase price, the value was still frozen at the time of the sale. So any appreciation before death was still able to be moved out of the estate. And another disadvantage is that the assets do not receive a step up of basis at the grantor's death, although this is a consequence common among the use of irrevocable trusts. You're still on mute, Rachel.
Gets me every time.
Okay.
All right, so we'll move on to charitable lead annuity trusts. This is the last strategy that's impacted or is more advantageous when interest rates are low. So the goal with a CLAT would be to provide a designated charity with an annual donation stream while transferring the trust's remainder to non-charitable beneficiaries. So I think the easiest thing, I guess, Nastasha, if you go to the next slide, we'll just kind of talk about the process for creating the CLAT and how what happens during the term and what happens at the end. So basically what happens in the beginning, in the first year, the donor would make typically a large sum charitable gift to the CLAT. So typically, because there's a lot of administration that has to happen with the CLAT, you have to do a trust document, there has to be a trustee involved, there's annuity payment calculations every year. So like, it's better, we usually see these when the CLAT amount or the deduction amount would be $1 million or more, or the funding amount would be $1 million or more. So say the donor puts $1 million plus into the CLAT, they get a charitable deduction in that first year, in the year of donation, for the present value of the annuities, the annuity payments that will be made to the charity. So moving to the annuity payments during the CLAT term. So the CLAT has a term of years. During that term, the annuity payments are paid to the charity of choice. I think you can have a successor charity. If something were to happen to the charity, you can name a successor. But that will be paid to a 501c3 charity each year. And then at the end of the term, whatever's left in the trust would go to a non-charitable beneficiary, so children, grandchildren, whoever, or it can actually revert back to the donor. It's good in low interest rate environments because the annuity payments will actually be lower. So you're leaving more to the remainder beneficiaries at the end of the CLAT. So that's the kind of rub you get with the interest rates. But again, this is a good strategy to use if you're going to have a big income, if you or a client is going to have a big income year and they're wanting to do some income tax planning and help soften the burden of maybe what's going to be a large tax balance due. And they've been thinking about doing some charitable gift, and maybe they don't want to give the charity a lot of money up front, but they like to sprinkle it over a number of years. This could be a good option for them. Okay, then we'll just, there's a couple of strategies we wanted to talk about that aren't really tied to low interest rates, but they're kind of applicable, either low hanging fruit items or, you know, strategies that are good to use maybe in 2020 because of the higher exemption. So the first one we're going to talk about is the spousal lifetime access trust. So the goal in the SLAT is to transfer appreciating assets out of one's estate by using either all or a portion of their lifetime estate tax exemption. But in using the SLAT, they're retaining indirect access to the assets through their beneficiary spouse. So I think, again, Nastasha, if you can go to the next slide, we can kind of show them the diagram of how it would work. And I think it'll lend itself to a good conversation. So in the SLAT, you have two spouses. You have the grantor spouse, and then you have the beneficiary spouse. In the SLAT, one spouse will contribute assets to the SLAT. And then during the grantor's life, the beneficiary spouse, so the bubble where it says grantor spouse, that beneficiary spouse has discretionary income and principal distributions for health, education, support, and maintenance during the grantor's life. Upon the death of the grantor, the remainder in the trust goes to the remainder beneficiaries, either outright or in trust. So with the SLAT, the one major benefit, and we'll talk about an example, is that grantor. So say you have a client or it's you, and you know, I want to use some of my use it or lose it exemption, but I'm afraid that I'm giving too much away, or I'm not comfortable giving this amount away. If you're comfortable that your spouse will still have access to those funds, you would still have indirect access to it. So we'll just go through a couple of key things to consider if you're considering a SLAT. The first one is that only one spouse or the grantor spouse should be contributing separately owned assets to the SLAT. This is because the beneficiary spouse is many times named as the trustee. If they're the trustee, they cannot also be a grantor. So if joint assets were transferred into the SLAT, that's technically would be treated as if the trustee / beneficiary spouse had transferred assets in as well. In that case, the IRS would claim that the trust is included in that beneficiary spouse's estate, which kind of defeats the purpose of the SLAT to begin with. So you definitely want the grantor to have separately held assets transferred into the SLAT. There's an issue, like if everything is held jointly by the two spouses, you'd have to transfer everything into the grantor's name. You definitely don't want to do that on one day, transfer everything to the grantor's name, and then turn around the next day and transfer it to the SLAT, because the IRS can combine those two transactions under the step transaction doctrine. So you definitely, if that's the case, you'd have to have some time in between the two steps, if you will. Some thought leaders say, you know, in 1 year, do the transfer to the one spouse, and the next tax year, then do the gift to the SLAT. So just something to keep in mind. And then as I was talking about, you know, this might be an appropriate strategy for taxpayers who are unsure if they can gift away a certain level. So like they want to use some of their use it or lose it. But this allows them to have that indirect access to the assets through their spouse. So just want to run through a quick example related to that. So let's assume a couple has a $20 million estate. One spouse could use their full lifetime exemption and gift 11.58 to the SLAT for the benefit of the other spouse. The couple would still have about $8.5 million outside of the trust to use, and then the beneficiary spouse would also have access to that $11.5 million held in the trust. That's just one example. If, you know, the grantor doesn't have to use all of the 11.58, they can use a smaller amount. So in a second example, let's say they've used $2.5 million of their exemption they've used $8 million. So they've used $2.5 million of their use it or lose it, plus the 5.6 of the lower $5 million exemption. The couple would have $12 million in their own name, plus access to the $8 million held in the trust. So still have access to that $20 million, either directly or indirectly. But the SLAT kind of gives you a little bit of leeway or flexibility with how to do some planning with that. And the last thing we wanted to mention is that the SLAT might not be the best strategy to use if there's kind of relationship uncertainty, because in the case of a divorce, the grantor spouse would lose that indirect access to the trust because the beneficiary spouse would still remain, they would have access, and if those two people are not together anymore, that obviously would create issues. We have heard from attorneys that there are ways to draft around that issue when you're initially drafting the SLAT document. So if you have any clients or you're going through that planning, that would be something to consider. And then the last item we want to bring up that's not related to low interest rates is irrevocable life insurance trusts. So basically anyone that has probably a permanent life insurance policy, maybe not so much term, but whole life or permanent, those policies should be held in an ILET, not in their own names. So the benefit of holding it in an ILET is that the death benefit is not included in the taxpayer's estate. If the insurance policy is held personally, those death benefits are included in the estate, which can create, if you already have a taxable estate, then you're paying 40% on the death benefits that are held personally. So if you already own a life insurance policy personally, the best thing to do would be to transfer it now. You'd have to file a gift tax return to show the transfer to the ILET, and potentially you'd have to use some of your lifetime exemption if there's a value to the life insurance policy. But just know that there's still like a 3-year clawback period. So the IRS, under the tax code, that life insurance policy, if you were to die within the 3-year period after the transfer, it's still included in your estate. So it's always best to do it as soon as possible, because you want to start that 3-year clock ticking. If you're thinking about purchasing life insurance, it's best to just pause and draft an ILET, have the ILET hold the life insurance policy from the get-go, because then you don't have to worry about the 3-year clawback period. And there probably you wouldn't have to use a lot of your, probably any of your gift exemption to have the policy in the trust to begin with. And then also we wanted to just to make sure that, when you're drafting the trust documents, it's important to think about the trust terms and also the trustee, because every year, once cash gifts are made to the ILET to pay the life insurance premiums, that trustee will have to send typically what's known as a crummy letter to the beneficiaries, telling them that they can basically take a withdrawal of the money that was put into the ILET. Basically what that does is it allows those premium gifts to be treated as present interest gifts, and then you can use the annual exclusion against those gifts. So it's not like a one-time thing. Things need to be done each year when you have an ILET. So it's important to pick a trustee that you trust, and that will be involved going forward. And then we just wanted to give you a quick example of kind of the tax impact of moving that life insurance policy out of the estate. So this example is a $20 million estate with a $4 million life insurance policy. So if they passed away and it was in their estate, their federal estate tax would be $3.368 million. If they moved it out of the estate it was 3+ years down the road, or if they just put it in the ILET to begin with, their estate tax would be 1.768 million. So it's a savings of 1.6 million, the 40% on the life insurance policy. Okay, and then moving on just to the CARES Act, we wanted to bring up some charitable related items from the CARES Act. The first being, this one's pretty big. The CARES Act allows for qualified charitable contributions to be deducted up to 100% of AGI only for 2020. So qualified charitable contributions are defined. So that means they have to be in cash. They can't be non-cash gifts. And then they have to be paid directly to a public charity. So anything made to a donor advised fund or private foundation would qualify for this 100% AGI limitation. Those are normally 20, 30, or 60% AGI limitations. This also doesn't apply to prior year carryovers. So if you have charitable contribution carryovers from 2019 going into 2020, just know that those carryovers are still subject to those other limitations from whatever year. So if it was a 2019, depending on what it was, if it was a cash gift to a charity or a donor advised fund, it's still limited to the 60% of AGI limitations. So just something to consider. If there's anything in excess of the AGI limitations, those charitable contribution carryovers will go up to 5 years in the future. And then if any taxpayers are using the 100% of AGI limitation, they have to make an affirmative election with their 2020 tax return. And then a slightly smaller charitable provision in the CARES Act. So for those that aren't itemizing because maybe the SALT limitation limits their tax deductions to $10,000, and then they don't have a mortgage and their charitable contributions typically aren't at the level to get them over the standard deduction. So the CARES Act is allowing for an above the line deduction of up to $300 for charitable contributions for those taxpayers who don't itemize. They also must be in cash to qualify for this additional deduction, not non-cash.
Right, so I'm going to go over a basic understanding of the difference between private foundation and donor advised funds. First, we're going to start with the structure and move on to tax reporting, grant making, contribution and distribution, and lastly, perpetuity. For private foundation is an independent legal entity. They are controlled by the founders and can appoint board of directors and trustees. They can hire family members to work together, and they can receive reasonable fees for doing so. Private foundation is usually recommended if the charitable assets are over 5 million. Unlike donor advised funds or DAFs, you can start with $100. Private foundations are funded by the family, and they don't get support from the public. So if you don't expect or have a family member who wants to get involved in the future, then you shouldn't do a private foundation. For DAF, on the other side, is not a legal entity. It is an account at a public charity maintained by the organization, and it is tax exempt. So same with the private foundation, they're both tax exempt. Generally with DAFs, they are easier to create. They require less compliance, provide more tax deduction, and less costly. Moving on to grant making, DAF has full control on where the funds will be donated. The donors or the family can make a recommendation, but the DAF has the authority to accept or the recommendation or not. Under DAFs, you can only give grants to public charities and not individuals. For example, you can give a scholarship, but you can't choose the recipients. However, with private foundation, a lot of the decisions are controlled by the foundation itself, so by the family. If you provide scholarship, you can choose the recipients, and you can also give directly to individuals if the grants meet the IRS criteria. And tax reporting. For private foundation, you have to file Form 990 PF annually. The entity must report the listing of assets, contributions, and grantees, which means that you can't be anonymous with your charities. The foundation will pay net investment excise tax of 1.39% of the investment income, because private foundation can hold cash, investments, mutual funds, publicly traded securities, bonds, real estate property, and more. For DAFs, you're not required to file state or federal returns. And contribution. As you can see on the slides, the DAFs have greater tax advantage. With DAFs, you can bunch your contribution, which means that you can double your charity giving in year 1 and not giving any in year 2. This will allow non-itemizers to reduce the overall tax liability in year 1 and 2. For private foundation, you are required to distribute at least 5% of your previous year's net average assets. Unlike DAF, there is no distribution requirement. And lastly, for perpetuity, with Profit Foundation, you can choose the successor advisors. The ability to choose and control give the future generation the opportunity to continue the foundation. For DAFs, they usually only allow 1 or 2 generations as appointed successors. In conclusion, both Private Foundation and DAFs are good to use when you have a significant income next year. The cost of maintaining a charitable vehicle is often the main driving factor in deciding which option is best. Definitely lean on both, maximize the tax treatment and balance the need for control and anonymity.
A current hot topic in wealth transfer is how the Secure Act essentially ended the stretch IRA. Retirement accounts inherited post January 1st, 2020 by all beneficiaries other than spouses, disabled or chronically ill individuals, or minor children are now subject to the 10-year rule. So all of the funds must now be withdrawn by the end of the 10th year, following the year within which the account holder dies. For large IRAs, it can have a significant tax impact. So we wanted to take a simple example of a child who inherits a $1 million IRA. The beneficiary could spread out the withdrawals, say at $100,000 a year for 10 years, or they could take $1 million distribution in year 10. Either way, the difference in the tax impact of this is significant compared to being able to stretch those distributions over a beneficiary's lifetime. So some of the techniques discussed to try to stretch or plan around the unstretchable IRA are to use annual RMDs to purchase permanent life insurance, to have a payout to replace amounts lost to the taxes for the beneficiaries. There's the utilization of an accumulation asset trust. This technique can extend the length of the payments as the trustee would have discretion over the beneficiary distributions, and those could be stretched over more than 10 years. But it does not really restore the financial benefits of the stretch because it's taxed at a 37% trust tax rate, and the IRA assets must still be paid out to the trust within 10 years. There's also a CRUTICRAT workaround and a ROTH conversion in full or in part. So the CRUTICRAT workaround, it utilizes the fact that charities and charitable trusts are exempt from the 10-year tax acceleration rule, and the trust can receive the IRA account tax-free. So roughly speaking, the charitable remainder trust would inherit the IRA account tax-free, and then distributions could be made out to the beneficiary for their lifetime or a maximum of 20 years, depending on the term of the trust. And then there'd also be a charitable deduction for the trust or the estate based on the timing of the gift. It's a complex calculation that needs to be run to determine if the strategy is more advantageous than the beneficiary inheriting the IRA outright. However, given the right variables, the strategy offers the opportunity to reduce taxation, stretch beneficiary payments, and benefit a charitable cause. Converting a traditional IRA and transferring wealth via Roth IRA can be a good planning tool. It is especially advantageous when asset values are depressed, because on a smaller account value, there'd simply be less taxes due. And you can plan partial conversions to remain inside current tax brackets. The estate is reduced by the amount of income taxes paid on the conversion. And so the income taxes on the assets are essentially prepaid. And after conversion, there'd be no required minimum distributions due while the owner's alive. You have tax-free growth in distributions. And then if tax rates increase due to political leadership changes or national debt complications, conversions or distributions, they might be taxed at higher rates in the future. So it's a powerful estate planning and wealth accumulation tool. Just some things to make you aware of, though, is that if the strategy works, you should plan to make the payments of the taxes on the conversion with non-IRA assets. So you need to make sure there's cash flow to convert. A planning idea is to consider utilizing net operating losses to help offset income for the conversion. You could try to couple the conversion with a large charitable contribution to offset the tax. And even though they're not required in 2020, in general, you could utilize RMDs towards the tax on partial conversions.
So even though this presentation is focusing on federal issues, we thought we'd be remiss if we did not mention at least the impact of state inheritance or taxes on wealth transfer planning. Even if the size of an individual's estate tax allows it to escape federal estate tax, it may still be subject to state inheritance or estate tax. While we won't go into all of the filing requirements in detail, we're just going to take a brief look at PA inheritance tax and some planning ideas to help reduce the potential tax burden. So in Pennsylvania, inheritance tax is calculated based on the value of taxable property and the relationship of the beneficiary to the decedent. So assets going to the spouse or children under the age of 21 are taxed at 0%. Assets going to all other lineal relatives like children over the age of 21 or grandchildren, parents, even grandparents are taxed at the rate of 4.5%. Assets going to your siblings, but not step siblings, are 12%. And then assets going to anyone else like friends, nieces or nephews or step siblings are taxed at the collateral rate, which is 15%. And while there are some expenses and other deductions allowed that could reduce the tax burden, this basically means that any gift going to your adult children upon your passing is going to be taxed at 4.5%. Depending on the size of the estate, this could mean a significant tax burden to the estate and thus less that will be going to your beneficiaries. So what planning opportunities can you take advantage of? Pennsylvania does not tax the proceeds of life insurance. So one of the easiest planning opportunities for Pennsylvania inheritance tax is to name high rate beneficiaries as the beneficiaries of your life insurance. For example, if you were planning to leave $100,000 to your nieces and nephews, if this was accomplished by cash from the estate, it would be taxed at 15% or $15,000. But if you instead make them the beneficiaries of a life insurance policy you have that has a death benefit of $100,000, there will be zero PA inheritance tax and your estate will immediately save $15,000. Another benefit to this planning idea is that it's not irrevocable. So because beneficiary designations are easy to change, you're not locked into this plan or even these beneficiaries as you would be under a more permanent planning idea. Another option would be to consider making gifts during your life instead of at your passing. So Pennsylvania only taxes assets being transferred at your death or within 1 year of death. So if you're considering making lifetime gifts, it could provide at least a 4.5% benefit depending on the beneficiary. And if it works within your long-term financial plan and retirement goals, you could consider making gifts up to the federal annual exclusion amount, which is the $15,000. This way, there's no impact for Pennsylvania or federal purposes. And another benefit to this idea is that you get to actually experience your loved ones enjoying the gift that you've made them. Another idea that you could take advantage of is creating a trust. So as we previously discussed, trusts like GRATs or CRUTs are an efficient way to move assets out of your estate. These provide a similar benefit for Pennsylvania inheritance tax purposes that they do for federal estate tax purposes, which is moving appreciation of certain assets out of your estate to your beneficiaries in a tax efficient manner. And if you hope to purchase a second residence or a vacation home, you could consider buying one out of state. But huge caveat, you have to be wary of that state's inheritance and residency laws. So for example, many people consider buying vacation homes at the New Jersey shore. However, New Jersey has its own set of inheritance tax laws, and they tax real estate and tangible personal property. However, under New Jersey's law, their Class A beneficiaries, which would be spouse, children, parents, and grandchildren, are exempt from taxation in New Jersey compared to the 4.5% rate for the same type of beneficiaries in Pennsylvania. For other beneficiaries, though, the rates range from 11 to 16%, depending on the relationship with the beneficiary and the amount of the transfer. So depending on your beneficiaries, you could really actually be hurting yourself by purchasing a home outside of the state. And another word of caution, many Pennsylvania residents with shore houses try to avoid taxation of real estate by holding that property in an LLC. And while this will avoid New Jersey inheritance tax, Pennsylvania has taken the position that intangibles anywhere are taxable in Pennsylvania, whereas real estate located in another state is not. So by putting it into an LLC, you're actually pulling it back into Pennsylvania. And obviously there are many issues to consider when planning for estate inheritance tax, but we just want to highlight a few of the opportunities and pitfalls.
Okay, so no matter what wealth transfer techniques might be employed, however, studies have shown it is likely generational inherited wealth will be lost. I wanted to take a look at some research done by the Williams Group, a wealth consultancy based in San Clemente, California. They surveyed 3,200 affluent families over 25 years and found that 70% of inheritance is often depleted by the third generation and 90% depleted by the fourth. What are the reasons for the lost wealth? The same study found 60% is the result of trust and communication breakdown among family members. 25% is directly due to a family's failure to prepare the heirs. 12% is because there was a failure to establish core family values, and only 3% was due in the end to bad professional advice. So while we know it's not easy to overcome the fears, emotions, family issues, lack of time, and breakdowns in communication that typically lead to the loss of generational wealth, these hurdles are not impossible to overcome. It is possible to prepare heirs and communicate about the legacy while using wealth transfer techniques to retain significant control, reduce taxes, and protect assets if the commitment is made to invest time and resources into the business of the family. We wanted to make some important closing suggestions. If you haven't already done so, choose to be explicit about your family core values. It may sound trivial, but try to schedule a family meeting along with a trusted advisor to discuss them and put them in writing. This conversation and the values that it establishes will lay the foundation for communicating, educating the next generation, and cultivating good stewards of the family legacy. Get the next generation involved and collaborative. Consider utilizing smaller projects, investment or philanthropic decisions over multiple years when possible to allow future heirs to learn to work together to make intelligent decisions about money. Partnering with the Scranton Area Foundation on a philanthropic initiative for the family would be an excellent way for heirs to understand and learn to be stewards of the family values and legacy, to communicate and work together, and to become more experienced with financial decision-making. You should also try to couple your wealth disclosures with ongoing education by experts and trusted advisors about money and how it functions, asset classes, returns, compounding interest, taxation, and setting realistic expectations on cash flow out to heirs. And finally, we wanted to strongly urge you to consider enacting at least one or more wealth transfer techniques to take advantage of the current favorable conditions before interest rates really start to increase, taxes are raised, or exemptions are brought down. Thank you so much. We'll turn it over to Laura now.
Thank you, Elizabeth, and thank you to the team at Drucker and Scaccetti, I'm sorry, mispronounced it, for your content-rich presentation, so timely, so many wonderful comparisons and themes that are so important to so many of us listening today as we either make those choices on our own or we guide others into making the right choices for their estate planning, life planning, charitable planning needs. We really appreciate your time and expertise in this. I want to particularly thank Elizabeth Witko, who connected with the foundation. It's wonderful for us. And obviously, you have your information there. So if anyone specifically has specific questions that they want to ask privately outside of this presentation, they can contact anyone from the team. So we're very grateful. It was really, really enlightening. We have it recorded also. So anyone that wants to refresh, go back, get additional information on what was presented, or wasn't able to attend but signed up, wants to see it afterward, this will be available. What I'm going to do next is I'm just going to briefly take us through some of the items that were discussed, but just some of the ways potentially that if anyone is interested in learning more about specific types of funds that the Scranton Area Foundation, or any other community foundation that's in your regional area can manage. You know, that's what I'm going to take us through very quickly on, but these are things that we specifically can help with. So I am going to share my screen quickly. All right. And so one of the things that, when we think about the types of funds, the types of charitable funds that individuals might think as they're shaping their legacy, as they're considering all these tax and estate planning implications, two of the types of funds that the Scranton Area Foundation manage, and when we think of our 200+ funds under management, they're either in the category of permanently endowed or non-endowed. And these really help. The way to illustrate this is permanently endowed is when an individual, a family, an entity is thinking about something that establishes a legacy, that is long-term, that they are not interested usually in sunsetting or closing in any way, that this is something over the long haul. It's all about perpetuity. Those are the type of funds that you typically see at a community foundation or other types of foundations. And that forms the majority of the types of funds that individuals will establish here. The other type is non-endowed. And the non-endowed fund is really about temporary, often short-term. It's sometimes in lieu of establishing a nonprofit organization, it can be to establish a specific kind of charitable project or goal, maybe run a race or do something that highlights a need. And sometimes also individuals or families will choose the non-endowed structure because maybe they'll really want a much higher payout rate than what could ever be in line with perpetuity. So those are the different types of fund structures when we think about funds. I know we heard a lot about charitable trust. We heard about donor advised funds. Those are extremely timely, important, popular vehicles. But when we back it up and we think about the types of funds, sometimes we'll go into it's permanently endowed or it's non-endowed. One of the things I also want to highlight is several years ago, the foundation established what's called the Medallion Partners Program. And that was based on the theme that, individuals have a really strong relationship with their investment advisor, their financial manager. And these are something that if a family wants to partner with a community foundation to handle the management of their charitable legacy, they can still do that and maintain having their assets invested with that trusted advisor through the Medallion Partner. So probably about 5 years ago, the foundation established this, whereas we vet and we go through a process with our board of governors, investment managers from a variety of firms. And those individuals that have these trusted relationships with donors maintain them, they maintain the assets, they manage the funds, and the Scranton Area Foundation would do the back end, the front end work, recommending grants, working with various aspects of that. So it's truly a partnership. So that's something that we do have. We have about 30 Medallion partners right now. So I just want to point that out because it's truly a charitable partnership in that regard, where the client or the donor is the prime focus. So we heard about charitable trusts and donor advised funds, and those are both things that the Scranton Area Foundation manages. Donor advised funds, probably the most popular, I think, that we heard and that we experienced, most popular type of fund vehicle because of the flexibility involved in it. And so those are truly growing. Another type of fund that we see very frequently, and I will attribute it to the fact that when we think about the regulations that go into regulating scholarship funds, often that is something that, regardless of whatever place a family foundation or an individual is, it's much easier to do that under a community foundation because we already have the parameters in place. And often, at least to our knowledge, they are some of the more scrutinized types of funds. So that's something that we have a lot of here, the scholarship funds. So families will frequently establish scholarships. That's something to think about. We do all the work in terms of connecting with the guidance counselors, et cetera, et cetera. However, the goal is to make that legacy fund a possibility. A type of fund that we see frequently, maybe less so than we used to in the past, is a donor designated fund. That's where a donor decides that they have a specific charitable organization that they want to support, or specific charitable organizations they want to support, and they're not interested in flexibility year to year, they will establish a donor designated fund. Everything's going directly to that organization. Whereas the donor advised fund is more about making those decisions, that activity every year. So this is a different type of fund, that is when a donor is sure that they want to make that decision specific to a type of charity. One of the things we try to encourage as a community foundation is sustainability for nonprofit organizations. And that's why we want to take a concerted effort to make sure that we're providing as much support in terms of gift planning, sustainability planning for nonprofits. And a lot of ways that nonprofits can do that is through an agency endowment fund, or sometimes it's called an organizational endowment fund. And that means that, in lieu of managing their own endowment or their own foundation, often this nonprofit organization will establish a fund at the community foundation, like the Scranton Area Foundation. We will manage their agency endowment fund. Sometimes they'll even include carve-outs in the fund agreement that allow them for, flexibility. For example, if there was an issue with a boiler or a roof, whereas, yes, it's about perpetuity, but it's also about allowing that organization to have immediate responses. What I'll talk briefly about, sometimes what we're starting to see too with these agency endowment funds is when it's done in partnership with a community foundation, that nonprofit organization can take advantage of other charitable planning vehicles that could then feed the sustainability of this fund. Field of interest funds are really when a donor decides that they have a cause specifically they want to foster. Maybe they want to foster historical preservation, the environment, animals, healthcare. The foundation will manage all of the grant making for that, conducting the RFP process, soliciting for grants, and managing that in line with the donor's needs. And when I mentioned before about the organizational endowment or the agency endowment, a new way that the foundation has set up a charitable vehicle so that nonprofits can maximize the growth in those funds is through charitable gift annuities. And the foundation now offers charitable gift annuities, which means that a donor that's interested in income while making a gift for a variety of the tax benefits that were discussed previously can choose to take out a charitable gift annuity with the Scranton Area Foundation. But one of the interesting things about that is that the residual gift from that, again, we heard about previously, we heard all about the different trust structures. The residual gift for the charitable gift annuity not necessarily would have to go just to the Scranton Area Foundation, but could go to support those organizational endowment funds that are housed within the foundation. So a donor that has a specific care about, for example, Griffin Pond Animal Shelter or Outreach or the United Way, each of those organizations would have funds that do have funds within the Scranton Area Foundation. Those charitable gift annuities that nonprofit guides their donor to at the Scranton Area Foundation, then the residual gift goes directly into their endowment fund. So that's one of the ways we're trying to help nonprofit organizations foster plan giving and sustainability. A little bit about some information on how charitable gift annuities work, not to take a lot of time, but it's one of those types of funds where it's a $10,000 minimum. It's starting at a level that's more manageable and more accessible. So it's on the spectrum or the sphere of planning, it has a key role. And my last slide is to remind us that, yes, charitable gift annuities have a $10,000 fund minimum at the community foundation. Again, encouraging accessibility and philanthropy. Endowment funds have a $5,000 fund minimum, and there's no minimum on non-endowed funds. And so that's specific to our foundation. But again, I think we heard in the presentation by Drucker and Scaccetti that, there's so much more when we think about all types of charitable planning vehicles and charitable planning tools. And, whether an individual chooses to have a donor advised fund at a financial firm, or whether you have it under a public charity like the Scranton Area Foundation, there's so many different vehicles to consider. But we're here to help in charitable planning. keeping the assets in the community, fostering community growth. Happy to partner with distinguished firms like Drucker and Scaccetti. And with that, I'm going to close my sharing of the slideshow. And I'm not sure if we've had any questions come in. Sometimes people want to digest the information, watch the recording again, but if there are, we will see. And if not, I will take the time again to thank our panelists from Drucker and Scaccetti and thank all of you for joining us this morning. We appreciate it. It was very, very interesting.
Thank you for having us.
Thank you, everyone. Stay well and stay safe, and we appreciate you joining us this morning. All right.
Bye.
Thank you.